welcome to the Monday Futures Market Outlook for February 6, 2012. This is Patrick Ceresna. For those of you that have not had the opportunity to try out the eMiniSource.com trading room, complimentary memberships are available. I want to start off by taking a look at that US dollar index, and overall the last month has been defined by a market consolidation, and we've seen a pullback now right to that 78.50 zone down below. Our retracement zone lies in the 77.50 to 79 area, and we have already seen a little bit of consolidation here. This doesn't necessarily mean that the US dollar is ripe for a new bullish breakout just yet, but it is quite possible we could have even a false start up towards 80 and then a very quick pullback back down to even the lower end of that range around 78 or 70, even a temporary drop to 77.50. In the bigger picture, we believe the US dollar will find supports in here and eventually will bottom and reverse bullishly on the upside. Just not necessarily convinced that it has to begin in, let's say, this week or something of that nature. But in the bigger picture, this is a level where the US dollar probably will be accumulated. Part of that US dollar thesis comes from trying to analyze the euro, and when we take a look at the euro currency, we've seen that it's now finding a little bit of overhead resistance right around that 132 level. At this stage, the euro more than likely is going to follow kind of a pattern like this, where it's going to probably come back down and still maybe even yet potentially retest to a little bit of a higher high, as high as 134, and if there's a real catalyst, it could go as high as the 135, 136 level. In the much bigger picture, we believe that that will contain almost all of the upside of the euro for the early part of this year, and at that after this move is over, the euro probably will begin another drop lower, which would be the catalyst that drives the US dollar higher. So we'll be watching. So we're a bigger picture bearish the euro, but don't believe that necessarily the next few weeks have to be the beginning of that new downtrend. When we take a look at the 30-year Treasury bonds, we saw them come right to the top end of their range, reject right up along there, and now consolidate lower. In fact, that we can tuck even that support resistance now to more like the 145 to 147 zone, as we've now seen a number of rejections off that 145 handle. At this stage, we're more than likely now going to come and retest that support line around that 140, 141 level. We still think it's probable that the Treasury bonds are going to even head down towards the 134, 135 level on the downside over the upcoming month or two. In the much bigger picture, we do not believe that this necessarily has to spill into a crash on the bond markets, as in terms of a major top and reversal, but probably further consolidation to test support lines is likely in store here. Next year, I want to take a look at copper futures, and when we take a look at copper, we've been looking for a little bit of a consolidation on the downside, and really didn't even come into the Fibonacci retracement zones that we've sort of marked off with that blue box. Really, at this stage, we're now looking at a scenario where copper is attempting to break out to a higher high again. And this certainly has the potential to, even if there's enough momentum, take it up to the 410, 420 area in the upcoming weeks. But in the bigger picture, we believe copper will start to find some overhead resistance levels and start far more of a sideways consolidation rather than an upwards trend. Next year, when we take a look at crude oil, we've sort of overall been trying to remain relatively bullish crude over the last month or so, but overall the price action is far more neutral, if not is starting to show real signs of distribution. Overall, we still cannot rule out the possibility that this is a bullish flag that can still break out if we have any solid push above like the 98, 99 level on the upside, and then subsequently a break above 101 to 103. But overall, there's a lot of distribution candles which indicate that every time there's short-term strength, it's being distributed. Overall, this 96 support line is going to be very critical. A break of that level would open the window for a test of the 91, 93 level below. and a test of 91.93 would really put to the test of whether or not crude oil is going to remain in a very bullish environment. And so we're watching very carefully. While we trade above 96, we'll try to leave a little bit of a bullish bias. Below 96, we're far more neutral, and certainly below that 91-93 zone, we would become far more bearish on crude oil. So let's watch the levels. Next here, we're going to take a look at gold. Gold rejected right off the first test of its late November highs, and with a very strong bearish engulfing pattern. At this stage, gold came up to its overhead resistance levels and is giving some sort of signs of a little bit of distribution into this, into that what was a very, very strong month of January for gold. Overall, the first sell-off here will probably be accumulated, so we'll be watching to see whether support lines around 1650 and 1700 contain initial sell-offs in gold. And then likely at that point, another rally attempt that fails along those highs again will probably mark the highs of gold in the cycle. So we're still remaining relatively short-term neutral, but in the bigger picture, we don't believe gold is in a position to suddenly break to new highs. But we'll be watching and seeing how the price action develops in the upcoming month. That brings me to want to take a look at the S&P 500, and before we look at the daily charts, I always want to start off with a weekly chart just to kind of look at the bigger picture. What we've plotted here is an 80-week moving average, and when we look at the market trending above or below that zone, you can see that it very well depicts the bull and bear market cycles we've gone through. We've had a number of false start signals over the last year, pushing above and below, but the blue trend line continues to actually be pointing higher on the moving average, and that with us now trading above that, there is still a distinctly bullish bias to the S&P 500 trend, while we are approaching some of the key overhead resistance levels. Nonetheless, we would need to see some serious bearish price action to reverse this existing trend on the weekly charts. That brings me to want to take a look at the S&P 500 and try to look at the daily chart trend. And while on the short term, the breakout that occurred on that jobs number certainly may lead to some further follow through and maybe full testing of the highs that were put in 2011 up in the 1350, 1360, 1370 zones. We still believe at this stage, with this current rally now being a month and a half in length, at some stage we need a proper healthy market correction. That kind of a correction doesn't have to be a very strong one the way we traditionally look at, like for instance like the August crash that occurred. More than likely this may end up being just a 5% market correction that could very quickly just grab 60-70 S&P points on the downside off the highs, and then find support and then subsequently rally again into the month of March. So we even though we are looking for a correction, we don't necessarily believe the first one will be a market crash, and will more than likely just present itself as a buying opportunity. Just very quickly looking at the key intermarket observations and some of the key things that we are looking at from not only short term but longer term. Right now, again, the U.S. dollar bias, we're coming up to support, but it doesn't mean that the U.S. dollar needs to begin trending higher anytime soon. So short term, we remain basically very neutral to slightly biased lower on the U.S. dollar, but long term, we are bullish the U.S. dollar. In the same regard, commodities, we are short-term neutral, but along with that U.S. dollar forecast, we are relatively bearish long-term on these commodities, and we believe we want to be underweight commodities. On the bonds, we're still looking for the testing of those lower support lines on those on our plays on the bonds, but longer term, we still believe there's room for yields to continue to drop, particularly in the third and fourth quarter, where we may traditionally see a much weaker stock market, and money may be moving away from risk assets and into some of the more defensive plays, which could push the bonds still to higher highs. And in regards to the stock market on the short term, we remain biased higher, even though there will probably be some sort of 5% market correction coming up. We still believe that we may even see 2-3 months of market strength before we start seeing some heavy overhead resistance levels and market corrections. We overall want to classify our long-term perspective on the stock market more neutral, even though as we approach the second and third quarter, we may become a little bit more bearish depending on how high the stock market gets. But definitely in the short term, we're going to maintain bias higher. That was your Monday Futures Market Outlook. Thank you for joining me.